It's a big week of earnings, $7 trillion to be exact of market cap that's going to be reporting and thereby having a major impact on the NASDAQ 100 and the market as a whole. On Tuesday, you have Microsoft and Google reporting, and then on Wednesday, you have Meta, followed by Thursday's earnings reports of Amazon and Apple. Now, expectations are low for big tech, but are they going to be lower than what the analysts are expecting? Last week, we saw Netflix surprise to the upside. It's rallied 20% since, broke it out of a range that had been stuck in for months. Then on the other side, you had Tesla, which has been lower since its report came out. But I think if the market can get through this batch of tech earnings this week, there's a good chance that it can rally into the next CPI report and the FOMC statement that comes out next month, which will be the next big catalyst for the market, which could be for better or for worse. We don't need to worry about that at this point in time because it's not a bridge that we're having to cross at this moment. But right now, what we do have to cross are these tech earnings, and they are big. Now, one of the things you want to watch out for, while yes, it's going to be important for these companies to have some good earnings relative to what analysts are expecting, it doesn't necessarily equate to a market rally thereafter. It'll pop the market initially, but oftentimes you'll see a company like Apple, they'll have blowout earnings and you'll think, okay, the market's going to rally big time the next day, particularly the NASDAQ, and instead it actually sells off despite Apple still staying up. And so you got to watch out for those kinds of possibilities because they do exist. But if the bulls want even a chance at continuing the rally that we've seen over the past week, it's got to be able to get through these earnings reports without any major blunders. So let's go ahead and get into the charts and see what I'm looking at from a technical standpoint and what we can expect from a support resistance level. But first, make sure that you like and subscribe to this video. You know, I always appreciate it when you guys do that. Plus, click that little bell thing on the screen so that you get notified when I do one of these videos or live streams. And click the join button down below so that you can get all my members only videos that I do multiple times each and every day for just the members of this YouTube channel. Now let's take a look at our first stock. It's going to be Microsoft, stock symbol MSFT. Okay, we have a downtrend that's still in place that hasn't been broken yet. And then you have a little bit of a basing pattern. I'm not a huge fan of the Microsoft stock. I don't think it's all that great. Okay, I don't think there's a lot of conviction in terms of an edge that can be traded either higher or lower. But you do have a little bit of resistance here that's worth paying close attention to. If it can break through this resistance, there's not a lot of resistance that takes place thereafter. You have a gap right here that goes back to September that has yet to be filled. If it can fill that gap, that gives it the opportunity to go all the way up to about 267 from its current price of 247. That's a pretty good move. But ultimately, if it does perform well during earnings, you're going to want to watch out for this 279 price point here. That's where you're going to see the potential for some profit taking, just as we've seen in the past. You also have underneath it a big support level. This is all part of the declining channel that it's inside of. A nasty miss versus analyst expectations could send this all the way back down to the lower channel band. And at that point, you're going to be wanting to watch for whether or not it can bounce off of that level. Now, let's look at Google. This is probably my favorite stock right now among all the big tech stocks. It just has a really nice, clean setup. But with it reporting on Tuesday, it's hard to get too excited about it because I'm not willing to play the earnings. But you have this nice basing pattern that has formed. What you would like to see is a somewhat of a muted reaction to the earnings report that gives you the opportunity to be able to get long on this stock. You have an inverse head and shoulders pattern, first of all, with the left shoulder, then you have the head, and then you have the right shoulder. So really good price action there, nice base, needs to break out of it, but you also have some resistance here as well, and that goes right alongside of this base breakout that I was just showing you. So if it can break out of this base, that also pushes through this resistance, which makes it to where there's not a lot of resistance left until it gets up to 121. So there's opportunity for about 20% upside. Whereas if I'm trading this stock, I'm putting my stop loss below last week's lows, which gives it about a 4-to-1 reward to risk ratio. Now here comes the real problem, child. I really hate Meta. I think Meta is just one of the worst stocks out there to trade. Now, it hasn't been kind to investors, and I'm having to always look at this from the weekly chart because there's nothing else that really matters right now as it pertains to the stock. This weekly chart is huge. You have support going all the way back to 2016. And unfortunately, it broke this support and it's tried to break back above it, but it's yet to be able to do so. It tried to break back above the broken support last week. It's now resistance. Couldn't do it. So now it's trading below it. It's trading below all the weekly moving averages. But just because the chart's really bad doesn't mean that it doesn't have the potential to bounce, because you just saw on Netflix last week where it's a stock that's been hammered and yet it managed to have an epic rally. So perhaps we're starting to see where some of these really downtrodden stocks are going to catch a bid from these earnings reports. You also have a declining trend line. And again, we're still on the weekly chart because really that's the only one that matters to me at this point. This declining trend line has not been broken, but it's been tested multiple times, 4 times in fact. So if you're going to get bullish on this stock, I need to be able to see this thing break at least the declining trend line going back to April. Now on to Thursday's reports. Amazon. This stock is pretty interesting to me. You have this massive topping pattern, confirmed it a while back, and you have a significant support level that goes all the way back to 2018 that it has managed to hold. In fact, bounce off of it in May and June. So we got close to testing it again this past month, but it managed to rally. You have a similar basing pattern to that of Microsoft, but the difference is you have this declining channel that looks pretty playable here. But what you need first is for the earnings report to come and go, because it's not worth playing Amazon ahead of earnings, because who knows how it's going to respond to the report that comes out. It could miss really badly and you're down 20% on this stock. And yes, it could still rally as well, but it's not worth it from a reward to risk standpoint. But if you have a reaction to the earnings report that's neither great nor bad, and it can kind of stay within this area here where it just broke this declining channel, there's an opportunity to get long there as well. And if you get that rally, be mindful of resistance at 145. And if the earnings report's bad, or there is a sell-off similar to like what we saw with Tesla, then keep your eye on this purple line here, this big support level, because that could offer up some support for the stock to bounce off of yet again. And finally, Apple. Anything bad that comes out of their earnings report, this is the support level you're going to want to watch. This is a big time rising support level going all the way back to 2020. It has to hold that level. Resistance overhead is going to be where it's always been. That's this declining resistance from January of this year. It's tested it 3 separate times. Each time it's tested, it has sold off. So that is huge and very important that you keep your eyes on that. In the meantime, there's this declining channel that it has managed to break out of from a short-term standpoint. And if you can get a little bit of a retest, let's say if you can get a retest back to this short-term breakout level at around 145, 146, that would be really nice. That would offer up a good opportunity to get long from a reward risk standpoint, but it needs to hold at least this orange line in order for me to get interested in possibly buying this stock. What's important to remember is that it's very enticing to want to play these earnings, okay? But what we have seen over the course of this year, especially in a bear market, is that when the earnings don't go the way you expect it to go, it can be really harmful to the portfolio. And a lot of these people buying out of the money calls or out of the money puts, they're expecting something to happen that doesn't materialize. That also costs a lot of money because a lot of people's options will become instantly worthless overnight. But the trading journey is so much more than one trade, one earnings season, one options play, one swing trade. It's about being consistent and about extracting money out of the market on a consistent basis over time. If we put our hopes and dreams into one stock or into one earnings season, we may get lucky, but we can't sustain that luck. In the end, it's about being wise stewards of risk, of our capital, and making sure from one trade to the next that we're showing the same kind of diligence and managing the risk and extracting profits out of the market. If you enjoyed this video, I'd encourage you to like and subscribe. And tell me down in the comments below, which company are you most optimistic on going into earnings, and what is your expectations for them? I want to hear about it. Thank you guys, and God bless.